This just gives you a brief highlight of essentially our history from listing on November 9th of 2017. Three of the acquisitions that we've had. And then on the right-hand side, you see some charts that show some of the growth in DPU and distributable income that we've had over the time that we have been in operations. Our next slide moves into a little bit about sort of our locations, the types of places that we invest. Not all investors in Asia are as familiar with the markets we invest in. We don't invest in gateway cities in the US, which tend to be the places that are maybe a bit more familiar. Your LAs, San Francisco's, Boston's, Chicago's, those sorts of markets. Those have not been the leading markets in the US for quite some time. We call our markets key growth markets, and we'll see that on the next slide. But right now we talk about magnet cities. There's some other terms for 18-hour cities, super Sunbelt cities. Those terms represent the vast majority of our portfolio in terms of where they're located. These are places that have low or no taxes on the individual side. Some of them don't really have a whole lot in the way of corporate taxes either. We also have GDP growth, employment growth, population growth that typically in our markets exceeds the gateways, exceeds the US average. But in places that have great workforces with the right training, the right education, a lot of our markets are tech markets with a lot of folks with the right training for that. Good amenities, you've got good infrastructure, you've got low cost of living, you've got lower housing costs than you find in the gateways, but all of the same sorts of urban, I would say, really appeal of having, all of the infill, all of the restaurants, all of the entertainment options, all of the fun things that make for great cities. Plus, in the case of most of our cities, or at least many of them, or the vast majority of where we have investments, lots of outdoor activities, national parks, beautiful scenery, and the like. And it just makes overall these magnet cities really the first choice for Americans. And what we've seen is COVID has accelerated what was already happening, which was a massive move into these types of markets from gateways, from big coastal states into some of these more central states, and or in the case of Washington State, a bit more northern and still far more affordable than California types of states in the US. And that's where we've really focused for a couple of reasons. We really like those locations. We really like the types of businesses that are there in most of these markets, especially that Seattle, Bellevue, Redmond, Denver in Colorado, Austin in Texas, and to some degree, some of our other markets as well. A lot of tech companies, a lot of high growth companies in places like Houston. You've got a lot of healthcare. And actually, we've got that significantly in Dallas. I think our largest healthcare tenant is actually in our building in Dallas as well. So those are a lot of the reasons we really like the places that we are. People have been moving there. Businesses have been moving there. Let's move on to our next slide. And this gives you a little bit more information about the occupancy, maybe points out the individual locations, gives you a little bit of a picture of some of these buildings. But our tech hub exposure really in the markets I mentioned, that Bellevue, Redmond, Denver, and Austin, are pretty significant. We have a different looking portfolio, as you can see from some of these pictures. A lot of these are low-rise buildings. These are not your typical office towers in downtowns. We have some of those. We've got one at the Plaza Buildings, 1800 West Loop. We have a few of them in the portfolio. We also have a lot more of the lower-rise buildings that tend to be focused in our tech markets, because so many tech companies outside of Amazon, most tech companies are not located in high rises. They're located in their own campuses or in low rise buildings where they can put testing locations, they can put manufacturing locations, they can put heavy equipment on the ground floor and have offices above. And so that's what you see our portfolio made of. And that's why you see us having a very different tenant mix, which we'll get to in a couple of minutes, than most of our competitive set. And that's why we have the big tech focus. That's why we have the big medical focus. And a lot of the other positives about our portfolio are due to that reason. Let's move on to the next slide.
Okay, moving on to the financial highlights. Gross revenue and NPI decreased marginally year on year, mainly due to the reduction in non-cash straight-line rent and lease incentive adjustments. Leasing momentum had been impacted since the second half of last year due to the COVID-19 pandemic, which resulted in lower free rent and lease incentives given to tenants and hence the lower non-cash revenue. Excluding the non-cash income adjustments, adjusted NPI is up 2.7% year-on-year as the higher cash revenue from new and expansion leases in the tech hubs of Seattle and Denver, as well as the lower property expenses. So this brought distributable income for first Q 2021 to 14.9 million, 3.6% above last year. Our balance sheet remains strong with low aggregate leverage of 37.5% and significant liquidity. As at end of first Q, cash and undrawn facilities amounted to 93.5 million. On to the next slide for more details. As at end of March, the weighted average term to maturity of cost debt was 2.7 years, with an all-in average cost of debt of 2.82% per annum, and a healthy interest coverage ratio of 4.8 times. So back in 2020, we had refinanced all our long-term loans previously due in 2021, and with that, Core has no long-term refinancing requirements until November 2022.
As we move on to this next slide, you'll see some of our operational information. We leased about 2.7% of the portfolio in the first quarter of 2021. It's actually, well, a fairly high number for what a lot of folks lease, a pretty low number for us due to COVID and the pandemic and a lot of folks not being out in the marketplace. So we expect that to start to pick up. Given where the U.S. is now in terms of having a lot of vaccines having been administered, a lot of people starting to go back to work, a lot of states opening up, a lot of things opening up. We've got a slide that'll hit on that a little bit shortly. But, you know, the rest of 2021 is still probably going to be very interesting for all of us as we are figuring out about getting back into the office and things like that, as are our tenants, how much space they need and the rest. But we have managed to maintain a mid-single digits, 5.7% positive rent reversion during that first quarter of 2021. We've had our rent collections be very, very strong. We were at 99% during all of 2020. We're at about 98% in first quarter of 2021 due to some very minor deferment requests that we had that brought that percentage down a little bit during the first quarter. And then one of the key things to focus on and realize, as we're all concerned about what long-term is going to happen with office, what long-term happens in terms of demand, what long-term happens, and as people are they going to bring people back to the workplace or not? Our in-place rents are about 8% below our asking rents, so we have got a very large avenue there, not just for organic growth, but to protect against any declines in rent that may still happen during the remainder of 2021 before we expect 2022 to be the real turnaround once most businesses have brought their people back into the office during the late third to early fourth quarter of 2021. So we move to our next slide. This is going to touch a little bit more in detail on some of the things that I mentioned earlier about our tenant composition. So on the left, you're going to see our location and our diversification there, but with a significant focus in Bellevue and Redmond, which is what we call the east side of Seattle. At 43%, we've got about 12, almost 13% in Denver, about a little over 5% of our portfolio in Austin. So about 62% of our NPI is coming from tech hubs. And that explains on the chart on the right why we have technology tenants making up 28% of our portfolio. And then we've got another 8.8, call it 9% in medical and healthcare, bringing us to about 37% between tech and medical and healthcare. Our competitive set is going to be almost all professional services, finance, and insurance companies because they're just a bunch of tall buildings and CBDs of, generally speaking, for our Singapore competitive U.S. investing REITs in basically gateway cities with, big tall buildings where you find accounting firms and consulting firms and the like. But that's not where we've seen growth over the last 10 years. That's not where we've seen stability over the last, call it year and a half with COVID, and it's not where we expect to see growth in the future. And that's why you're seeing our competitive set start to talk about, we want technology tenants. We want to move to these 18-hour cities. We want to move to the Super Sun Belt And we say, great, we're glad to have people come join us in the markets we've been at since we started this REIT, giving people the option to invest in something that's very different from what they can find in the US on the stock exchange and what else they can find in Singapore. So we move to our next slide. This is going to show you our top 10 tenants. This is another big differentiating factor between us and our competitive set, whether that be US REITs or that be US office REITs in Singapore. You'll see that the top 4 tenants are all technology. We don't have any competitors that can say that. And there's 2 more technology tenants, and there's a medical and healthcare, biomedical applications in our building in Dallas in 125 in the top 10 as well. Our largest tenant is only 3% of our cash rental income. The total of our top 10 is only 20. Those numbers are a half or far less than half of the competitive set, meaning we have far more diversification, far less risk, far less tenant concentration risk in our portfolio. And we expect that to remain the case. We buy very large square foot buildings. We have some smaller buildings, but generally speaking, they're very multi-tenanted throughout our portfolio without a lot of concentration, as you can see here. And we think that works very well for us. And we think that's going to be something that's going to continue to work well as we move into the future of the post-COVID world. Let's move on to our next slide. And that's going to start talking a little bit more about the market, the U.S. economy, the U.S. recovery. U.S. GDP increased 6.4% first quarter of 2021 after a massive increase in the fourth and third quarters of 2020, after a huge fall off due to COVID in that second quarter, especially of 2020. Unemployment had peaked at about 14.8% in April of 2020. It's back down to 5.8% as of the end of May of 2021. We have seen a ton of people back into the workforce. However, the labor force participation rate, the chart on the right-hand side, shows you a much, much, much lower participation rate in the workforce as of today at only about 61.7% than what you saw back in 2019 prior to COVID. And so we've got a lot of people still sitting on the sidelines in the US. We also have more jobs than those 6.6 million people that are seeking jobs available today in the United States. So we really do expect to continue to see positive improvement as we move forward. How quickly that translates into office rent is anybody's guess. We are certainly not expecting the rest of 2021 to be a banner year. It's going to be tough. Our occupancies that you saw on an earlier chart, we expect to stay probably pretty consistent with where they're at. We could see some decreases in some of our buildings over the remainder of 2021, and then we certainly would expect in 2022 to see things starting to pick up as more people go back to work. If you're unfamiliar with it, there is a excess, if you will, unemployment benefit in the United States right now by the federal government, which is providing people somewhere at the current pace about $300 a week more than they would be getting under their normal unemployment status for those without jobs. And it's continued to keep employment down in the US. That's going to be ending in September. A number of states are putting forth packages to end it now. Some already have, and we expect that's going to really help with employment, with growth, with bringing businesses back into the workforce in the US along with their people. So, again, we are pretty cautious about the rest of 2021. We're still not seeing a whole lot of folks that are out looking for new space. We're still seeing some shorter leases. We're seeing a lot of folks still asking for 1 and 2 year leases. However, we're seeing a lot more that are now more comfortable signing more normal 3, 4, and 5 year leases, at least for our portfolio. Still shorter leases than you typically see of our competitive set because we're in very strong markets with a lot of tech tenants, and we're very comfortable, generally speaking, signing shorter leases because they help us grow in time. I'm not sure if you've seen it on one of these slides or maybe you've heard it before, but we have about a 2.6% average built-in rental escalation within the leases in our portfolio. And we have markets that outside of COVID, prior to COVID, if you will, especially in the Pacific Northwest and Austin, we're more than double that rate. And so, a shorter lease that lets us move up our rents in time with the market in an up market, we consider to be quite positive. And so, while we've been comfortable doing some shorter leases for folks that just say, look, we need some time to figure out what our space needs to look like. Can you please give us a short lease for now? To which we've said yes many times. We are seeing folks back in the market looking at longer leases now. So we move on to our next slide. This talks about a little bit more some of the benefits of some of our markets. We're in Texas, Colorado, Florida, Washington, four of the fastest growing states in the U.S. over the last 10-year period. Some of our target markets include Utah and Arizona, which are two more of those top 10 states within the U.S. That Salt Lake City area is one of our target markets we've talked about from day one. Arizona also houses some are in the Phoenix area and the right sub-markets in Phoenix. And in the U.S., we've got markets, sub-markets, and micro markets. And it's important to have people on the ground who really know about those things. And so that we can be investing in the right micro markets, because Phoenix is an enormous place. I have relatives that live there. I've been there a bunch of times. It's huge. And you only want to be in certain micro or sub-markets within that market. But we have the expertise through Pacific Oak in the US that helps us figure that out. And so we feel quite comfortable in the markets we're in, being sure we're in the right location, because location really is the primary important thing when it comes to investing in real estate. So some of those demographic trends that got accelerated by COVID: suburban migration. A lot of Gen Xers and others after them have had kids, or they're moving out. They're looking at trying to find actual homes. The whole idea, the appeal of the city is maybe less appealing when you've got kids and you want to have a house and a backyard for them to play in and things like that. So we've seen that. The public open spaces, the parks, the national parks, the fun activities, all the outdoor things, safety and health concerns, affordability is huge. These have accelerated moves into the markets that we invest in, and the other markets that we've been targeting and will continue to target in places I've already mentioned, plus like North Carolina, where there's a couple of cities that we're very interested in investing in, or Nashville in Tennessee, which we've talked about from day one as well. So, you've got less dense, you're getting a lot more bang for your buck, your housing costs are lower, the states have a lot lower taxes in most cases, some are zero. People have been moving, and COVID has accelerated that with the work from anywhere sort of philosophy that's taken place. And even as people are getting ready to go back to the office, we tend to see some of these moves permanent, and we expect to see a lot more offices opening in our markets. Whether that's sort of a hub and spoke model or some companies keep moving like so many have remains to be seen, but we think one or the other or both are probably still in the future in the US. Let's move to our next slide. This talks about getting back into the office. 70% of CEOs and human resources folks, finance leaders, say they expect to have their employees back by fall of 2021. Fall of 2021 starts in the second half of September of 2021, and a ton of big companies made announcements they expect to have their employees back in the office by September of 2021. We've seen a lot more that have been moving it up rather than back. So we've seen some moving their folks in June. And we've got a lot more that have announced July, and some are still September or later. But we are seeing even all the big tech companies that said, we're going to let people do whatever they want, who know and have known and are now realizing in some cases when they say that it is really important for people to be able to work together, for people to be able to collaborate, to have a company culture, that has to be done in person. And that's what we're seeing. That's why we're seeing, I'll say, they're going to be coming back to the office. Look at our middle chart, you've got employee office visits. In a number of our markets, those are in the 40% already. And that's, essentially May data when you're looking at the 2nd of June. Whereas the gateways are far, far behind at sub 20 for many of them, 25% or less. And a lot of our markets are, well above those gateways, just because of the types of cities that they're in and sort of what's been going on in various places in the US. And we found that with infection rates and the things remaining relatively constant across the US, there have been states that have opened very effectively, and we happen to be investing in a lot of those. When you look at the right chart, you see vaccinations in the US. Over half the US population's had at least one dose. 43% is fully vaccinated, and we're over 60%, maybe well over 60% with at least one dose. When you look at the over 18 working population, especially since we've only had vaccines available to 12 to 18 for about the last month or so. So, we've seen huge progress in the US on that. We've seen cases drop to the lowest levels in essentially a year, with somewhere between 10 and 12,000 on average 7-day averages over the last couple of weeks in the US, which is far, far below where we were even a few months ago. And so as we have more people getting vaccinated, more people have had it, we're getting very close now to herd immunity in the US, which we think is a positive, but still needs to translate, and we expect will eventually translate into office leasing, and those other things are going to be a positive for us. But right now, people are still somewhat cautious, especially in certain markets in the US. So we move to our next slide. Here's a list of some of the companies that have recently made announcements about when people need to be back. You'll see JP Morgan at the top left, 21st of June. That's this week. That was yesterday. We've got Goldman Sachs looking for late June. Apple says we're getting back at least 3 days a week in September. Facebook is opening in July. BlackRock's bringing people back in September. MasterCard is mapping it out and figuring it out. And there are dozens and dozens of other companies in the US that have already brought people back and that are planning to do so sometime between this month and the end of September, with a few more trickling in later on in the year. So we are expecting this to remain a mixed bag of flexible working, with people in the office 2, 3, 4 days a week, people at home and elsewhere or in maybe strategic other locations for 1 or 2 days a week. And then we expect to start seeing things maybe normalize a bit more. But there may be a little bit of a new normal, but with some of the desires to have more space for individuals and a mix of companies that are just growing, and companies are saying, I don't need quite as much space because I got people working from home part of the time. We're hoping to see something that approximates sort of the historic status quo in terms of office leasing, but we don't know for sure. Nobody does. We're still waiting. But we think things like this page and all these announcements are certainly positive for where we are in the US in general and where the office market is in the US as well. So we jump to our next slide. Hopefully we'll jump to, there we go. This is just sort of a summary for you to take a look at as we wrap up the presentation here. We've got exposure to growth in defensive sectors. Technology is both technology is really growth. It's turned into, for a pandemic type of time, as being a bit defensive as well, seeing as how many technology companies did well. During the pandemic, medical has been both for a long time in the US. Very diversified portfolio. Chris touched on our 100% unsecured debt, low aggregate leverage, no near-term refinancing needs, positive rental reversions, an occupancy level of 91.6%, which is far and above the average for the United States. Built-in 2.6% annual rental escalations. I knew it was somewhere in our presentation. I just jumped the gun earlier and talked about it before I got to the right slide. So, these give you a lot of the positives. A couple of the others we touched on were the low tenant concentration risk, the high percentage of, low concentration technology tenants that are within our portfolio, the tech concentration. So there's just a lot of positives. And while this is just a trying time for all of us and a questionable time, we are feeling like we're starting to see things start to turn a corner. And so we're starting to be, to use an overused phrase, cautiously optimistic. But again, 2021 is going to be tough no matter how you slice it. But we're really hoping that 2022 is sort of the turnaround year for office in the US. And so that's going to wrap up the presentation.